On January 6, 2026, the precious metals world crossed a line. If you have a pension, a savings account, or a trading app, that line now runs straight through your life. It was not a meme stock blowing up. It was not a rumor on Reddit. It was a research note from one of the biggest, most conservative banks in the Western system. Bank of America doubled its long-term gold price targets and came out openly bullish on silver. Almost at the same moment, silver futures were pushing toward $80 an ounce and physical coins were disappearing from dealer shelves. When a bank like that changes its mind, it is not doing small investors a favor. It is admitting that the old playbook no longer works, that the silver shortage is real, that roughly $40 trillion of new Chinese money is bearing down on a fragile paper market, and that the number glowing on your screen can be miles away from the price to put real metal in your hand. For a long time, Bank of America treated gold and silver as the boring hedge in the corner. If you have been stacking metal over the last decade, you know the lines they pushed. Gold and silver are dead money, stocks and growth names are the future, and any spike in metals is just a temporary overshoot that will slide back to normal. That same institution now assumes a very different world. On the gold side, it is no longer arguing about whether $2,000 an ounce is too high. It is penciling in an average somewhere in the middle of the 4,000 range over the next cycle, with plausible paths that reach toward 5,000 if today's debt and deficit trends keep running. That is tied to actual arithmetic, not theory. United States federal debt has already moved beyond $38 trillion. Annual interest costs are heading toward $1 trillion a year and, for the first time, have started to match or even outrun what Washington spends on national defense and major health programs such as Medicare. When a government pays more just to carry old debt than it does to fund the largest military on earth, $4,000 gold stops looking like a doomsday fantasy and starts to look like basic accounting. On the silver side, Bank of America has raised its formal targets into territory that most professionals a few years ago would have laughed off as silverbug fantasy, with the metal trading well above its old highs in their base cases. Outside the bank, analysts plug those same gold assumptions into historical relationships between the two metals and end up with 3-digit silver in many of their models. The point is not that any one forecast is sacred. The point is that large banks do not tear up their own playbook to do small investors a favor. They adjust when the framework they trusted for a decade begins to fail, when the side of the portfolio they once called safe, the bonds and the cash, like paper, starts to look like the real source of danger. At that stage, the question is no longer simply whether gold is going up. The better question is what kind of financial system needs $4,000 or $5,000 gold just to stagger forward, and what that implies for a much smaller market like silver once the crowd finally pays attention. Now set that against what you can already see. Silver sitting near $80 on a futures screen, ordinary buyers struggling to find coins, dealers quoting $90 or more for American Eagles, and a Wall Street institution that used to wave silver away as background noise, suddenly treating it as a strategic asset. So what snaps first? The oversized short positions, the currency itself, or the belief that the spot price on a screen is the real thing? To get closer to an answer, we have to leave New York, follow the trail of new money into Beijing, and then lay that beside two other pressures that almost nobody on the big trading desks wants to discuss out loud. Think of it as 3 forces squeezing into the same narrow space. First, the flood of new currency from both East and West. Second, a physical market that has been running persistent shortfalls between supply and demand. Third, a stack of paper promises built on the assumption that metal would always be easy to source. As we dig into each of those, keep one question in the back of your mind. What does an $80 quote really mean if the real world stops lining up with it? Start with the money. Over the past decade, China has expanded its broad money supply, the measure that includes cash, deposits, and near cash, into the low 300 trillions in yuan, which works out to roughly the mid 40 trillions in United States dollars. That is now larger than the entire United States money supply, and by some estimates rivals the combined stock of money in the United States and the Eurozone. We saw a small version of what that kind of creation does during the pandemic when Washington pushed out $5 or $6 trillion in a short burst. Rents jumped, food prices surged, asset prices shot higher. Now imagine that sort of push not as a one-off, but spread over years in China and measured not in single trillions, but in tens of trillions. There's another detail that rarely makes it into the headlines. When Washington expands its balance sheet, a large share of the new money tends to show up first in financial markets, in large technology stocks, index funds, complex trades, and corporate buybacks. When Beijing loosens policy, more of it is directed straight into the real economy and into hard assets, into energy security, critical metals, food reserves, and more recently, monetary metals. The central bank in China has been adding to official gold holdings month after month. State companies and refiners have been taking bar after bar off Western markets. Industrial firms have been signing contracts that lock in future silver supplies for solar panels, electronics, batteries, and military uses. If you can create your own currency at will, a higher dollar price per ounce is not frightening. The focus shifts to a simpler question. How many ounces can we move into our vaults before this window closes? That way of thinking runs straight into the way Western banks have tried to manage silver for decades, through promises on paper rather than metal in hand. Now move from money to the metal itself. Global silver mine output has been sitting around 800 million ounces a year. In recent figures, mines produced a little over 830 million ounces, while total demand from industry, jewelry, investors, and solar installations pushed above 1 billion ounces. That leaves a gap of well over 100 million ounces a year, and surveys show that this gap has been repeating, not appearing once and then vanishing. The extra metal has been coming from stocks that were built in earlier decades, and those above ground reserves are now being drawn down. At the same time, the quality of what is left in the ground is slipping. The richest and easiest deposits were mined long ago. Today, many producers have to dig deeper, crush more rock, and burn more fuel just to pull out the same ounce. In many regions, the average grade has drifted lower, which means more tons of earth for fewer ounces of silver. On top of that, around 70% of global silver supply arrives as a byproduct of mining other metals such as copper, lead, and zinc. That ties silver output to the health of completely different markets. If global growth slows and large copper or zinc operations cut back, silver production can fall even while demand from solar, electronics, and investors is still climbing. A small percentage drop in supply during a strong surge in demand does not just make the market tight. It sets the stage for an ongoing shortage. Add in the chance of a real investment rush, with central banks spreading their reserves, utilities, and defense contractors signing long-term deals and households swapping cash for metal, and it becomes clearer why prices have had to move. From the perspective of anyone trying to plan future supply, silver at $70 or $80 an ounce is not some wild bubble. It is closer to the minimum needed to keep enough new projects alive in a world of higher energy costs, lower ore grades, and growing industrial use. Even if the quoted price were to double tomorrow, nobody can press a button and create new ore bodies. It can take a decade to discover, permit, and build a serious mine. Policymakers can alter interest rates in an afternoon. They cannot rewrite geology on a video call. Most people first meet the silver price on a screen, not in a vault or at a coin counter, and for years that number on the app has mostly been a price for paper promises, not for metal changing hands. What you see is the result of contracts, futures and forwards and swaps and unallocated accounts, a stack of IOUs for silver that can usually be settled in cash, extended to another date, or offset against each other. Inside that world, it has been considered normal for large players to sit short hundreds of millions of ounces on futures exchanges, while the physical trade carried on quietly in the background. Official data show that big banks, as a group, have owed very large amounts of metal on paper compared with what mines bring out of the ground in a single year, and critics point out that once you add the trades that never show up on an exchange, the real figure is much larger. You do not have to accept the most alarming estimates to see the basic problem. The whole arrangement depends on two habits staying in place. Most participants must stay happy to settle in cash instead of asking for metal, and there must always be enough bullion sitting somewhere that any attempt to pull out real ounces can be met without stress. That pattern is changing. Industrial users and state buyers are asking to take delivery. Ordinary savers who watched years of money creation are less willing to trust paper substitutes. Each ounce that disappears into a central bank vault, a strategic stockpile, or the back of a private safe is 1 ounce that no longer stands behind the IOUs. A short position in that setting is more than a trade. It is a promise to deliver something that takes time, fuel, and geology to produce. And the more of those promises are stacked on one side of the ledger, the more violent any rush for metal can become. Now picture how this feels from your chair. You open a trading app and see silver futures circling around $80 an ounce. The candles are green, social feeds are full of victory posts, and it is easy to believe that the job is done. Price up, problem solved. The trap sits right there because that quote is not a law of nature. It is a number produced by leveraged contracts on a particular exchange during particular hours between people who, in many cases, never touch the metal. The reality check does not live on your phone, it lives at the coin counter. Call a large online dealer and ask for an American Silver Eagle at the exact futures price, and you will almost certainly be turned down. More likely, you will be told there is no stock at that level, and you will be quoted a final figure deep into the 90s, once the extra charge above spot is added, especially for the most sought-after coins. We have already seen versions of this. In the early months of 2020, the extra cost on Eagles jumped by $10 or $20 over the reference price, while supply chains were tangled and demand surged. In calm conditions, that extra margin is usually modest, a couple of dollars on basic rounds and a little more on branded coins. When it swells into double figures and refuses to come back down, it is not just a case of greedy dealers. It is a signal that the paper reference price is lagging the real world. In a friction-free market, large firms would simply buy paper, demand delivery, and sell into the coin market until the gap closed. If that gap stays open, something in the delivery chain is not working. This is the kind of environment in which big institutions are forced to stop talking about bubbles and start admitting that there is a deeper shortage that the screen still does not fully reflect. If this all sounds abstract, look at what has already happened in other metals. In March 2022, nickel prices on the London Metal Exchange suddenly shot straight up. A huge short position collided with fear about Russian supply, and within hours, nickel futures were trading above $100,000 a ton. The move was so extreme that the exchange halted trading, froze the market for days, and even went back and canceled an entire session of trades after the fact. The chart did not calmly adjust. The rulebook was bent to protect the system. Palladium went through its own version of this. Years of tight supply pushed prices above $2,500 an ounce around 2019 and 2020. When a small, specialized metal tied to catalytic converters ran into a real shortage, the price did not drift gently higher, it jumped until buyers had to step back. These are early warnings of what happens when a market built on paper runs into hard limits in the real world. Trading halts. Margin calls spiral. Contracts are changed. If you think silver is somehow protected from that pattern, stop and ask what happens if industrial users, state buyers, and investors all try to lock in metal at the same time in a market that is already drawing down stockpiles. To see why this pressure keeps building, you have to step back from any single commodity and look at the way heavily indebted governments deal with promises they cannot fully keep. In broad terms, they have three choices. They can default in the open and tell creditors they will not be paid in full. They can inflate, paying back in money that buys less, or they can use financial repression, steering savings into assets that look safe on paper but pay less than the rise in living costs, so that the loss in purchasing power quietly repairs the state balance sheet. After the Second World War, the United States, the United Kingdom, and other major economies relied heavily on that third method. Central banks kept interest rates capped, rules and capital controls pushed savings into government bonds, and inflation was allowed to run ahead of those yields often enough that, over time, the real burden of the debt shrank. Between 1945 and 1980, real interest rates on government debt were negative in roughly half of all years. The debts did not fall because governments ran huge surpluses. They fell because savers were paid back in weaker money. The pattern today is similar. The cost of servicing the modern debt tower is climbing fast. Central banks and treasuries know that letting bond yields float wherever the market wants for long would risk accidents they cannot contain. So we see a familiar mix. Real yields that slip below inflation. Price rises that are presented as temporary but keep outpacing wages. Rules that nudge pensions, insurers, and ordinary savers into claims on a system that keeps issuing more of those claims. Precious metals sit almost alone as a way to step partly outside that structure. If silver stays too cheap, savers can escape some of the squeeze by exchanging paper promises for finite ounces. If silver and gold are driven sharply higher, that door narrows. Fewer people can afford to walk through it, and those who already hold metal experience a one-time shift in purchasing power away from the paper side of the ledger toward the hard asset side. Seen from that angle, a bank research note that says silver may need to trade much higher is not just a casual forecast. It is a quiet admission that for the current system to keep going, some real assets will have to move violently upward while the currency that measures them slowly loses ground. And that is the point where this stops being a story about charts and contracts and becomes a story about your day-to-day life, about what happens to the value of the work you have already done and the savings you still hope will protect you. You might not own a single silver coin. You might not care about futures contracts or how exchanges settle them, but you do live inside the same machine. Imagine you are retired. You spent 30 years working, saving into a pension fund full of bonds that were sold to you as safe. Your latest statement shows the balance drifting higher. On paper, you look fine. At the same time, your groceries cost roughly twice what they did a decade ago. Local taxes keep edging up. Medical bills creep higher every year. The gap between what the statement says and what your life actually feels like is your quiet contribution to cleaning up the debt. Or picture a young family. You get a 3% raise at work. The number on your payslip looks better, but rent is up 10%, childcare is up 15%. Insurance premiums never stop rising. In real terms, your time is being marked down even as the digits inch up. Or you run a small business. Your credit line moves with so-called market rates, so Every central bank hike shows up in your interest bill, while your customers, squeezed by higher costs, cut back on anything that is not essential. You are supporting a strained system from both directions, paying more to borrow while your real income erodes. That space between the comforting numbers and the harder reality is where the squeeze lives. When a large bank starts to plug $4,000 gold and much higher silver prices into its models, what it is really signaling is simple. It expects that squeeze to continue. It expects savers to go on absorbing the cost of past policy choices through returns that lag the rise in living costs. Gold and silver are not magic, and they do not repair politics. What they offer is something different. They are among the few assets that do not sit on the liability side of a bank balance sheet. When a major institution tells its clients to treat them as central holdings, it is not the result of some sudden change of belief. It is the result of arithmetic that leaves policymakers with slow currency debasement and this kind of financial pressure as the easiest path forward. There is another side to silver that rarely makes it into headlines. It is no longer just a hedge for private stackers or a vehicle for hedge funds. It has become a strategic raw material. Every solar panel, every electric vehicle inverter, every new generation telecom tower, every guided missile consumes silver. Industrial use has already set record after record as energy systems, electronics, and power grids are upgraded. If the price stays too low for too long, miners cannot justify opening new projects in a world of rising fuel and wage costs. Supply is then choked off, and the risk of shortages in key industries grows. If the price shoots too high too quickly, another type of strain appears as makers of solar hardware, electronics, and military equipment struggle to secure enough metal at predictable prices. At that point, silver stops being a quirky line on the commodities page and starts to look like a small but critical piece of national security planning. Governments do not enjoy waking up to find that a metal they once treated as secondary has quietly become a single point of failure in their energy and defense strategies. That reality is one more reason large institutions are rethinking where silver sits in the hierarchy, seeing it less as a speculative side market and more as a gauge of whether the system can deliver both an energy transition and financial stability at the same time. There is one last uncomfortable angle. When a market based on paper runs into real-world scarcity, the final backstop is never the invisible hand. It is the rulebook. Exchanges can raise margin requirements overnight, cap position sizes, halt trading in certain contracts, or insist that settlement be made in cash rather than metal. None of that requires a conspiracy. It is simply how stressed systems protect themselves. And it is exactly why the line between owning a contract and owning an actual coin matters. A contract can be altered, paused, or cashed by changing the rules. A coin that already sits in your hand is much harder to edit. So where does that leave you, looking at an $80 quote on a screen and a $95 coin in your hand? It means recognizing that in a strained system, the number in your app and the price in the real world can drift apart and stay apart, because that screen figure is only a reference point, not a promise. It also means noticing that the biggest players are shifting their stance, even if they never spell it out on television. When an institution that used to roll its eyes at precious metals starts publishing aggressive targets and calling gold a core holding, it is signaling how it expects the pressure to be managed. And it means starting to see silver as more than the cheaper metal beside gold. It becomes a gauge on the whole arrangement, on the tug of war between East and West, on the strain between financial claims and the metal that has to back them, and on the quiet loss that savers absorb when their returns lag behind rising living costs. What you choose to do with that is your call. The point here is to show you the incentives and the mechanics, not to hand out instructions. But as the distance between the screen price and the street price opens up, as more new money looks for something solid to land on, and as large banks move from resisting that shift to quietly adjusting to it, one question will not go away. What do you trust more, the changing number on the chart, or the motivations of the people who write the rules behind it? Think about that before you treat any price spike as the end of the story. In systems like this, it is often only the first chapter. Thank you for watching, and please subscribe and like the video. Nothing in this documentary is financial advice. Always do your own research and consult a licensed professional before making financial decisions.